if I look back historically, they're going to be increasing the percentage you have to take out every year. So this is an important thing to know. You hit RMD age, whether you're currently taking them right now or you're going to have to take them when you're 72 or 73. Again, it is all based on your year of birth. So make sure you're looking this up, but you need to make sure you're hitting the percentage that's required. That's the main point of this. All right, everyone, welcome back. 10 Fears of Retirement. The podcast, the book, the journey. I'm Alexander Pushman, and I'm going to walk you through chapter 6 here today. So on this episode, we're kind of getting into a doozy. And what I mean by that is when we talk about RMDs, required minimum distributions, and I know I've referenced them in a couple of the prior episodes, but required minimum distributions, just to make this really easy, is basically when the IRS forces you to start drawing on your IRA, 401k, 403b dollars and says, hey, now it's time to start paying taxes. And the second part of what we're going to talk about today in this episode, in this chapter, again, chapter 6, Fear 5, pertaining to the book, is going to be the tax game. So taxes. And what I mean by taxes is a couple things. Number one, who likes talking about taxes? Well, most people would say I do not. Which is why historically they are, when I talk about taxes, it's one of the most neglected areas of planning in retirement for proactive retirement. And what I really mean by that is like, hey, is there anything you can do today or over the next, short term, 3 years, 5 years, 10 years that could help reduce your tax liability later in life? Help reduce your tax liability for passing on money, legacy planning, inheritance, all that good stuff. So it tends to be a neglected area because, hey, taxes are confusing. They change a lot. So the two main conversations is going to be talking about required minimum distributions, aka RMDs, and number 2, taxes. So let's kind of start here. Again, as always, this is one where it's a little bit higher level. It's a little bit more complicated than a lot of the subjects we talk about because it's changing all the time. Just these two subjects, have changed a handful of times just in the last 2 to 3 years, and I'll kind of reference that as we dive into this. But keep in mind, if you have questions, this is a big one that a lot of financial advisors won't touch, and I feel bad for them. What I mean by that is like, I'll use one of my best buddies. He's been in the business for 20 some years. He works for a firm that won't allow him to talk about tax planning, that won't allow him to talk about RMD planning proactively because it's a liability. Okay. And so there's a lot of financial advisors who do want to dive in and help you on these conversations, but the companies they work for, the firms they work for won't allow them because it's a liability. And a lot of the times us as financial advisors, we can't charge for these services, or it doesn't really fit into our model on how we would make money on, managing assets and whatnot. So there's a lot of financial advisors who they're going to say, focus on the investments, and that's fine. And they're going to do a good job at that, but they neglect these other areas of planning for retirement, which is candidly one of the jobs or one of the reasons I have a lot of people come to me for second opinions and just asking questions, because I can talk about it and I can dive into it. So just understand that is nearly every financial advisor I talk to wants to talk about these subjects. Some of them can't. Okay. So let's start with RMDs, required minimum distributions. I've already said what it is, but basically this is where sometime, and again, historically, RMDs started at 70 and a half. And then the Secure Act passed, okay, in 2020. And basically what happens with the Secure Act is it says, hey, we're going to push back the RMD age. Okay, so now it's not 70 and a half, and it got pushed back to 72. Okay. Then the Secure Act 2.0 comes along, within 18 months of that, and it changed the rules again. So currently today, it's all based on the year you were born, date of birth. And kind of a fine line. If you were born in 1960 or later, your current RMD or required minimum distribution age is age 75. So a lot of people aren't aware of that. And that's a big deal because you got to think, hey, that's a good thing in the grand scheme of things, because it's if it used to be 70 and a half and now it's 75, well, that gives those folks and those families an additional 4.5 years before the government says you have to do this. It also gives you 4.5 more years of basically taking a proactive approach to your tax planning and your income planning and your distribution planning in retirement. So it's a positive thing. On the other side of the fence, though, you got to understand what you gave up and or what that looks like. If I look back historically, they're going to be increasing the percentage you have to take out every year. So this is an important thing to know. You hit RMD age, whether you're currently taking them right now or you're going to have to take them when you're 72 or 73. Again, it is all based on your year of birth. So make sure you're looking this up and make sure you're aware of when you are required to start drawing on your IRAs, 401ks, and getting those distributions going. Now, you might do that on a monthly basis naturally. Hey, Alex, I take $1,000 out every single month, but you need to make sure you're hitting the percentage that's required. That's the main point of this. Every single year you get older, the percentage increases. And I'm just going to use some general numbers because these numbers have changed like the wind blows. It could be 3.65% of all of your IRAs one year, and then the next year it's 3.71, it's 3.9. So every year it's going to change. And again, you just have to be aware of it because you might be hitting your number or taking more than you need naturally. But what if you're one of those people who's like, hey, Alex, I don't really need my IRAs. I don't draw on them. That's where a main issue hits. So let's kind of go back a little bit. And I'm going to walk you through this. You turn, again, 72, 73, or 75. And again, 75, if you were born in 1960 or later, this is you. So you turn 75, and let's just say hypothetically, the percentage of your IRAs you have to take out there is like 3.65% of all your IRAs. So one thing I'm going to hit right now is one question I get all the time. Hey, Alex, I just turned 75, right? I was born in 1961 or whatever it is, and I have to take out 3.65% of my IRAs. Do I have to take 3.65 out of each IRA I have? Let's say you have an old 401k, an IRA over here, and an IRA over here, and you have 3 separate IRA accounts. The IRS doesn't care if you take that 3.65 out of each one, or you take the accumulative of all these accounts, the value, and just take it from one account. It doesn't matter. Okay, so make sure you understand whether you take it from each one or you just take it from one account. It's 3.65% of all IRA dollars you have, okay? The second thing, your spouse doesn't matter in this conversation. IRA, individual retirement account. Your spouse, if they're taking their distributions, has no impact on your account. So it's 2 separate equations. So those are usually the 2 most common questions I get on this topic. All right. So you're turning 75. You're forced to take out your RMD. And again, remember, if you're born before 1960, you have a different RMD age. It's either going to be 70 and a half, right? 72 or 73. 1960 or later. Okay. It's all right. Now, I'm forced to take money out, and then I'm taking 3.65% out my first year. The very next year, it's going to be a higher percentage. And let's say it jumps up to 3.78, then 3.91, then 4.05. Every year, that percentage amount increases, which is often the problem families run into. You're now 81 years old, and you're taking out, give or take, 5.5%. And I sit down and I talk to people all the time who are big planners and, the water cooler folks who say, well, hey, I'm just going to follow the 4% rule, Alex. I'm only taking 4% out every single year for the rest of my life. Well, that number gets crushed in like the 4th or 5th year of your RMD. So it can't work. You can't use generalized rules in retirement. It's the same thing. And I talked about this earlier. It's the same thing when people say, hey, all I need is $1 million to retire. It depends. How much money do you spend a month? Again, if you spend 15 grand, you're burning through $1 million, 15,000 a month. Or if you spend 1,000 a month, that's a big difference. So you can't use these generalized rules. Oh, I'm just going to follow the 4% rule. And the main reason is because RMDs do exist. And the second reason is inflation. Okay. So be prepared for that. And again, I want to walk you through this because RMDs will create an issue on your income. You start having to take money out that you don't need. And again, this might not be you, but I see it more often than not, especially with more blue collar, hardworking families, saved a lot of money, not huge spenders, right? Live pretty simple. I always think of my in-laws on this one. Very, very good savers. They're very fiscally responsible, but they're not big spenders, and they don't spend a lot monthly. So what happens? Well, you have these IRAs and these 401ks and these Roth IRAs, and it doesn't really matter for Roth. So I'll get to that in a second. But, they're big savers, but they don't spend a lot monthly. And so what happens is year over year over year, your IRAs, your 401ks, they're growing. You're excited. Hey, I made 10%. Hey, I made 8%. Hey, I made 25%. And then all of a sudden, you get to this line in the sand, RMDs, and the government's like, hey, you need to start drawing on this. You're like, but I don't need the money. So let's just play out a scenario. And I just had this happen to me the other day. Client wasn't aware of RMDs. I was giving him a second opinion. One of my current clients sent him over to me as a referral, as a second opinion. I'm going through their situation. This individual happened to be about 70 years old. So they got a couple years to hit RMD. And I asked him, I said, hey, what are you going to do when you hit RMD age? What are you talking about? I'm like, that's when the government forces you to start taking money out. He's like, oh, I heard about this. Can you walk me through it? Here's the problem. I was only meeting with him. His wife wasn't really too involved with the financial planning. Again, that can go either way. And they got a couple $1 million in IRAs. Has a good pension, paid off their house, paid off all their expenses. So they only need like $4,000 or $5,000 a month. And that's everything. Entertainment, bills, utilities, going on vacations, Christmas gifts for the grandkids, all the good stuff. And I said, okay, well, what are you going to do? And for him, his RMD happened to be 73 years old. What are you going to do in 3 years when you're going to basically be forced, to take out like $75,000, give or take, based on the market between now and then? That's like a worst case scenario. He's like, I have no idea. I didn't know it was going to be that much. So think about this. This is the most common problem with RMDs you need to start thinking about, and you need to have a plan for. Again, it might not be an issue for you, but it oftentimes is when people aren't big spenders on a month-to-month basis. So here's a scenario. He's now 73, or again, whatever your RMD age is, and he's forced to take $75,000 out. 3.65%, give or take. And what's 3.65 of a million? Okay, so we're talking over 36 grand. And then times it by 2, because this family has over $2 million. And again, this is me being pretty nice about it. I think it's going to be worse because, again, the odds are that their funds will grow. But again, we're not going to get into that. So let's just say, give or take, they got to take 75 grand out. Number one, you're in your 70s, so you have Social Security. Okay, so your taxes could increase on just how your Social Security's taxed based on you taking that distribution. 2, your income level. 75 grand's a lot of money. High probability, and for him, it was true, it would take him from current federal tax bracket of marginal tax brackets of 12% today to 22%, and he'd have no control of that. Number 3, you're on Medicare. And it would also increase his threshold for his family of how much money they can take in, and his Medicare premiums would increase. So he had no idea any of this was coming. So again, it's all about, hey, you have to know the rules to play by them, right? Okay, number one, you're going to be forced to take out $75,000, give or take, more than you want. So your Social Security taxation could increase, and probably will for them. 2, your income taxes are going to increase. And number 3, your Medicare premiums are going to increase. And then, oh, by the way, you take $75,000 out. What are you doing with that money? So an educated investor is going to go invest that money, right? And they're going to go put it in a non-qualified brokerage account, whether it's a CD, a stock, an annuity, whatever you're putting it in. And then all the profits on those dollars are now subject to long or short-term capital gains. So now I've just added a 4th layer of a taxation issue for specific to your RMD that you have to do it, because I haven't told you the best part yet. If you don't take out your RMD, required minimum distribution, the IRS has a 50% penalty on that dollar figure. So let's use the current client I'm talking about. You know what? I don't need that money, Alex. I'm not taking it out. Okay, well, that number was, again, let's just use 75,000. So what's the penalty here? If you didn't take the 75 grand out, what's the penalty? 50% of that money. So give or take, he's got like a $37,000 and some change penalty I'm not talking about a tax penalty. And guess what? Think about this. How do you get your Social Security every month? Direct deposit, right? You don't think the government's aware of where your money is pertaining to like checking and banking? They could garnish your wages of Social Security. They have different ways they can penalize you. So it's like hey, you have to do these RMDs and make sure you're keeping up with this and make sure this is something you're talking about with a financial professional or your financial advisor, because these are the traps I see people fall into when they don't know the rules. So again, it's not saying that this is you guaranteed. It's just saying understand it, understand the different things you can do around it. So I'm going to kind of segue into tax planning and some different variables on ways you can kind of get ahead of this. And this is really a really important one-on-one conversation. So again, I can't encourage you enough. If you haven't had these types of conversations, whether you do or don't have a financial advisor, please feel free to reach out to me and my team. This is the stuff we enjoy doing because it's almost like a puzzle, right? You have this very unique puzzle to you and your family, and there's going to be different pieces that are bigger and smaller that do and don't matter more or less. I can give you solutions. I can give you ideas, okay? Part of this whole book was to educate people and kind of get out there some of these pitfalls that people run into. So if that's you, again, please reach out. We have a website. You can even shoot me an email directly. All that information, if you look in the book, you'll be able to go to our website and touch base with us there. And again, if you're listening to this podcast, it's all in the notes and everything. So just please come visit us if this is you. So kind of back to the taxes. So our RMDs, we know what those are, and I've kind of teed up the issues people fall into with the required minimum distributions. So let's talk about the tax side. One of the quickest and or easiest solutions that may or may not make sense for you, it depends on a lot of variables, is Roth conversions. Everybody's heard about Roth conversions. What's a Roth conversion? You take an IRA dollar or a 401k, 403b, you pay the taxes on it today, right, or this year, and then you convert that dollar to a Roth dollar. The catch is you have to pay the taxes on that dollar this year. It's added to your, modified adjusted gross income. So you have to pay taxes on it this year. Most tax professionals, my CPA included, say, Alex, why would you ever pay taxes before you need to do them? What are you, crazy? So I have conversations like that with a lot of tax professionals and CPAs. And again, I have a different perspective than them. I'm not saying it's right or wrong. A good tax professional is looking at what? This year, the last year of your life and what they can get those taxes down. What am I looking at? I'm looking at the next 20, 30 years. So I just have a different perspective. And the good news is math usually doesn't lie, but can be manipulated. So you have to make sure you understand all the variables there. So you take your IRA dollar today, you pay the tax, you convert it to a Roth, great. From the moment it's in a Roth IRA, you don't have RMDs. Why? You paid the taxes. So a lot of the time what I'm talking about with different families and different clients is, does it make sense for us to try to convert all your IRA dollars? Does it make sense to convert some of them, half of it, maybe none of it? Everybody's different based on income, spending, how much they have in their life savings of an IRA, 401k. So that's one easy solution. And again, just to hit the main point, if it's in a Roth IRA, you do not have RMDs. They can't force you to take it out because you already paid the tax. So then from that point of view, doing that conversion, that money will grow, hypothetically tax-free or tax-deferred, right? But it's tax-free on the growth. It's also tax-free when you take that distribution. And then the other piece of it, and again, I know I was talking about this, is when you get into that concept of our taxes going up or down, and in my professional opinion, I think they're going to go up because of the national debt, because we're in the second lowest tax bracket of history. So do I know for a fact your taxes are going to go down or up? No, I don't. But economics would say, hey, there's a higher probability that taxes could go up here in the next couple of years, next 10 years, et cetera. So the other thing to know just on the Roth, one asterisk to what I just said, is if it's in a Roth 401k. So a Roth IRA is basically when you do like a rollover and you're not in a company plan. If it's in a Roth 401k, it's still tax-free on the distribution or when you take the money out, but it still has an RMD. You'd say, well, Alex, that doesn't make any sense. Well, that's different rules under ERISA, which is kind of those employer accounts or retirement accounts through your company. So you want to get it out of the Roth 401k into a Roth IRA, and it's a simple rollover. And as soon as you do that, you don't have an RMD. But if you leave it in your Roth 401k, they will still force you to take money out when you hit your RMD age. But again, it's not taxable. You already paid the taxes. A silly rule, just be aware of it. Number 2 silly rule or asterisk I would put on it, once you do a Roth conversion, let's say I converted $10,000 this year from my IRA to my Roth or my 401k to my Roth, and I pay the taxes, I move it over. I then have to wait 5 years to touch that money. Okay, so I have to wait 5 years from the minute I did that conversion. I've had a lot of confusion. These rules have, I don't want to say changed, but fluctuated a little bit, and I think there's a lot of confusion on this one. Yeah, there's some rules on a Roth of like when you open it up, you have to wait 5 years or 59 and a half. But the other side of this coin is, let's say you've had a Roth open for 20 years and you do a Roth conversion, you still have to wait 5 years on that bucket of money per the IRS. Okay. So again, you may have or may not heard different things around that. That's usually one that people aren't aware of. So just know that's kind of the asterisk. You got to wait 5 years on the bucket that you convert over. Okay. So I know I already talked about Roth conversions, and that's kind of a hot topic, but in a couple other things that I do for tax planning, there's different ways to get your taxes down on a quick. I go through a lot of them in the book. This is a pretty long chapter for the record. Hey, you can pay down your mortgage quicker, right? So like, hey, what do I do with this RMD when I get it taken out? Like how can I utilize that money? I already said one, hey, you can go invest it in a non-qualified account, CDs, stocks, bonds, mutual funds, annuities, whatever you're getting, right? And go and invest that money, leverage your money, right? The second thing you can do is you can gift it. Hey, I'm going to give it to my kids. I'm going to, every year the gifting rules change. So just be aware of those thresholds. It's right around 18 grand right now, but again, be aware of it and talk to somebody to make sure it makes sense for you. But you can gift that money. You can do something for the grandkids, 529s, Roths, non-qualified brokerage, UTMAs, all that good stuff. What else can you do? Well, you can put it into indexed universal life insurance or life insurance policies. I like IULs the most, indexed universal life, for the simple fact that could be something that whether it's your kids or your grandkids, you can set up as almost like a pension for them where they get a tax-free pension later on in life. They have a cash value that they can pull from. And have a lot of cool features with it. But again, it's a life insurance policy, so that has to make sense. You can spend it. You get forced to take out your RMD, right? You can spend it. That's common sense. So, there's a lot of things you can do with that, but there is only one thing you can do with an RMD that can reduce your tax liability and make it a deduction on your taxes, and that's give it away to a charity, 501c3, or a church. That's called a QCD. Qualified charitable distribution. So, hey, you don't even take the money directly out of your IRA or 401k. You set up a direct contribution to the church, 501c3. And then now that RMD is considered a QCD, again, qualified charitable distribution, it is now not a taxable event. It is now a tax deduction for you. So if you're already given to the church, you're doing tithing, if you have a regular charity that you support, rather than having it come off of your credit card or your bank account, a really easy play, if it makes sense for you, again, verify this, with your CPA. That's my CYA right there. But make sure you have it come right out of your IRA, and then boom, you've reduced your tax liability. It's an easy one. And if you're already doing it, it's just a couple changes to those automated payments. So, taxes is confusing. RMDs can be confusing. If you're going down this path with me and walking through these podcasts, reading the book, like, you're already going above and beyond than most families. And I commend that, because it's not like, hey, these are party subjects, right? They could be confusing and they change a lot. So I get it. But this is a great chapter. I go through a lot of different things on taxes you can do. In the podcast, just for respect of not boring everybody to sleep, those were the main things I want to talk about today. Now, keep this in mind. When it comes to reducing taxes, there's 100 different strategies that you can look at, from inheritance to legacy planning, gifting money, you doing Roth conversions and all these other different things. You got to verify what is and isn't in your best interest. You don't want to be what's called overinsured, right? So just understand kind of all these limiting factors and make sure you got something that's custom for you. So again, I hope you're enjoying the podcast series. If you've read the book, I hope you enjoyed that and kind of going through this journey with me. We're getting in there. We're about chest deep right now. We got a little bit more meat on the bone here. But number one, again, if you have questions, if things are popping up that you want specific answers, listen, you could read 1,000 books. You go to 100 of those educational, seminars and workshops. Give me about 2 hours of your time, and I promise you'll probably never have any other questions regarding your retirement picture. Okay. So I would highly encourage you, free consultation. I'm not going to have any strings attached to it. If you want to take advantage of it, wonderful. I'd love to connect with you again, with me and my team. So if you have anything, please let me know, because at this point, this is usually when the questions and concerns really start boiling up. Does that mean? Is it not? Verify. Again, if it's not with me, that's okay. I want to make sure you're educating yourself, because again, it all stems back to education in this stuff, and it's complicated. So we'll see you next time. Thanks for joining us. And again, hope you're enjoying 10 Fears of Retirement, and we'll see you next time.